Hello and welcome MACPA members and partners. Here we are in the tail end of 2020, and for many employers, this year-end reporting cycle is overwhelming than ever before as organizations balance their tax accounts and prepare to distribute W-2s. W-2s that are based on more payroll-impacting regulatory changes that many of us can ever remember manifesting during a single calendar year. But before we dive into the details surrounding the new COVID legislation, tax credits, leave mandates, and more, let's take a quick look back at 2020. Do you remember back in January when Australia was on fire and we knew that that was going to be the defining moment of 2020? But less than 3 months later, we've been quarantined, unemployment rates were soaring, and the Olympics had been postponed. We worked at home through the summer, parents were becoming teachers and IT support wizards until the murder hornets arrived. And thank goodness that one didn't pan out. But then we were feeling, and we still feel, the pressure and uneasiness surrounding racial inequality in and out of the workplace, as well as uncertainty of how this historic election will end and our recovery efforts can continue. In a nutshell, this is what you and your clients have been through, in addition to the ever-changing regulations and inevitable subsequent reporting. So as you sit with your clients and look forward to year-end and plan for a successful 2021, I want to draw your attention to ADP's award-winning Accountant Connect technology. Here, you'll have access to all of your clients' reports that you can pull at your fingertips, along with additional tools to make your job easier. We'll provide you with benchmarking, analytics, as well as direct access to the Master Tax Guide so you can always have at your fingertips the legislative changes that are most impacting your clients. And with those legislative changes, it's been another source of pride for ADP to be in the forefront of the news. We made more than 1,000 feature changes in response to more than 2,000 legislative updates occurring in 60 countries. More than 4,000 of our clients were running more than 2 million Paycheck Protection Program reports, and we were supporting a total loan volume of more than $115 billion. We've been in the news. Wall Street Journal, Bloomberg, NPR, they've all been looking to us, more specifically our VP of Government Affairs, Pete Eisberg, to help decipher and provide guidance on this legislation. And with that, I'm excited to turn it over to Pete and his team of government affairs representatives. More than 100 years of combined experience has come together to help provide you with the strongest updates of the legislative changes impacting 2020 in your client's year-end reporting. Pete himself has more than 30 years of experience working with Congress and state legislation, being responsible for managing these legislative and regulatory affairs for ADP. He's covered a variety of employer compliance matters, including employment tax payments, major legislative change from the Affordable Care Act to the recent FFCRA COVID legislation. And with that, I'll turn it over to Pete and his team to walk you through strategies for surviving your year-end reporting.
All right, much appreciated. Well, in terms of agenda, I'm going to say as little as possible and leave a lot of time for the real experts in the room, which is we're very fortunate to have on ADP staff some very senior former government officials. Among them, on the unemployment insurance side, we have Tom Crowley. He was formerly U.S. Department of Labor unemployment insurance tax chief, and before that, had 30 years of experience as Deputy Director of Unemployment Insurance Taxes for the state of Maryland. On federal and state, employment tax reporting changes, we've got John Myatt, who's Director of Government Relations for ADP, covering federal agencies. And he had basically a 23-year career with the IRS in various employment tax roles, so quite the expert there. Fortunate to have him. Lastly, on state issues, we've got Charles Collins, who similarly had 30 years of experience as Director of the North Carolina Department of Revenue, also currently, I think, Chairman of the Southeastern Association of Tax Administrators. So very deep expertise across the board with federal and state agencies we have to look forward to. So I'll leave as much time as possible for them. In terms of sort of an overview of the year, it occurred to us that this was, just notwithstanding the whole COVID pandemic, very, very difficult from many, many perspectives, but strictly from a payroll administration and employment reporting administration perspective, this was a very, very unusual year, a very difficult year. There were, many sweeping bills that had immediate effect in the nature of, immediate support needed and stimulus needed for the economy. support needed for both businesses and individuals. These laws tended to be effective immediately. Really the trade-off, they tended to be fairly complicated because you had to satisfy both issues, which is, number one, providing this funding very quickly, very rapidly, and at the same time not opening it up to, a huge amount of fraud and abuse. So as a result, these various laws tended to be fairly complicated in how they were structured, and so administration from the perspective of employers, in some cases, quite difficult. So we'll go over some details of that and look in particular to year-end reporting kind of perspectives. How is that going to be affected? It's going to be a difficult year. I will say also that there are many details that are still unknown affecting year-end reporting. And generally speaking, looking at this array of laws, these laws, in general were immediately effective. The guidance related to those laws came out very unusually, as you're acutely aware, I'm sure, but just a stream of consciousness of guidance that came from Treasury, SBA, and others, Department of Labor, as quickly as they could get to it. But the effect was very unusual. Normally, you pass a law, and the agencies have 90 days or so to come up with details on how it would be administered, and didn't have that luxury this year. So we'll talk a little bit about how that plays out and how that affects employers. And just as one example, and I'm going to leave most of this for John Myatt to discuss in detail, but as one example, the Families First Coronavirus Response Act, FFCRA, that was primarily intended to provide supports for individuals, workers who, couldn't work. Their workplace was closed, or schools were closed, or childcare was closed. In most cases, there were just government shutdowns at the time. And so the focus was, how do we get assistance to businesses so they can continue to pay wages to employees who are on leave and can't work or are working from home. And this was generally for employers of 500 or less employees, but it was a very broad mandate. It was a mandate, so employers had to do this. They had to offer paid sick leave. They had to offer paid family leave this year. And this was at the same time that the businesses themselves were just trying to figure out, how do I stay in business? How do I stay open, in this new environment? Kind of a lot to ask. So administratively, added to burden for employers, there were very extensive U.S. Department of Labor rules as to benefits administration. For example, who qualifies, when do they qualify, how much do they qualify for? There were very extensive IRS rules and limitations on the related tax credits. So all that had to be sort of understood, built into systems. And as one example, again, looking at the year-end reporting implications, this law was signed on March 18th, went into effect April 1st, but it wasn't until July 8th that the IRS came out with a specific W-2 reporting implication. So you think about that. You had to design your systems to administer these new types of leave and build that into the payroll systems and keep track of it. And hopefully you did that in such a way that you were able to, when these rules came out on July 8th, and clarified that employers have to separately report these three different types of leave on the W-2 separately. Hopefully you did enough record keeping so that you can separately report the aggregate amount of family leave versus leave to take care of oneself, subject to the various different limits, that kind of thing. So it was kind of a lot. But anyway, just one example. There were many, many others. The biggest one of all, and I should step back and say the CARES Act, there were many alternatives to this that we were quite involved with early on as they approached, this one bill. I would say we're still relieved to some extent that some of the alternatives that were under consideration did not get adopted. But anyway, they did a good job of coming out with just a huge sweeping bill that did effectively provide support to businesses and support to individuals during this crisis. It included, many relevant, I guess a lot of provisions that, if they were enacted on a standalone basis, would deserve a lot more attention. The retirement plan changes, for example. Unemployment insurance supplement, very important component of this. I'm going to let Tom explain that. But as another example, the employer payment of student loans. very valid. It's a new program. Essentially, employers can contribute up to $5,250 to student loans of their employees, and it's on a tax-preferred basis, so there's no income tax, there's no payroll taxes. It's good for employers, good for employees. Great program, but it's only for 2020. And, in my view, it really got lost in the shuffle. I mean, there's so much else going on and so many other things that businesses had to pay attention to that, I don't know if many businesses paid, spent the time to pay attention to this. And it was a little bit, anyway, we'll see if it gets extended in future years. But it was just one minor point that was beneficial, but lost in the noise of the overall thing. The Paycheck Protection Program was the big winner, I should say. This is the program that resulted in getting funds out to businesses of under 500 employees, with some exceptions. But generally speaking, it satisfied the need for like 80% of businesses out there. Literally 5.2 million loans occurred, and there are only 6 to 7 million employers in the U.S. So most employers took a PPP loan, and they are at this point looking to have those loans forgiven, looking at getting those documents assembled and preparing to apply for the forgiveness process. I'll talk about that in a little more detail. But that was probably the biggest component and the most successful component. Interestingly, the CARES Act set these 3 points up, the Paycheck Protection Program, the deferral, and the employee retention credits, up as either-or choices. So employers could do the PPP or the employee retention credits. They couldn't do both. They could do the deferral and the PPP, but only until the PPP loans were forgiven. That was subsequently modified in June so that they could continue to defer Social Security taxes even after PPP loans were forgiven. But, for example, the deferral alone, there was, worthwhile, very popular among the larger employers in particular. We were a little bit concerned about the impact to small, medium-sized business, just from the perspective of, you're deferring an actual federal tax liability that could, generate a fairly significant amount that you owe the IRS down the road. So, deferring taxes now sounds good, but in December 2021, for a business that has as few as like 32 employees, they'd be paying essentially the equivalent of a 1 year's average salary for one employee. It would be due on December 2021, the same amount due December 2022. Very significant amounts potentially being deferred here. So plan accordingly is, I guess, our suggestion here. The employee retention credits, John will go into in some detail, but basically speaking, it's 50% of wages up to $10,000 for businesses that to just continue to pay wages. For employers of 100 or more, it was for payments to employees who were not working, so paid time off only. And if you had revenue losses related to the COVID-19 shutdown, that sort of thing. So again, we look forward to John's comments on the CARES Act. So we'll spend a little bit more time on the Paycheck Protection Program issues. That's changing rapidly. This has been the prime example of the stream of consciousness kind of guidance that we literally had from when this program was signed into law. At least 2 subsequent legislative bills were enacted to modify it. There were also over 30 interim final regulations issued, as well as forms and instructions that changed the program, sometimes retroactively and sometimes contradicting prior guidance. There were literally 50 different separate FAQs issued on the Paycheck Protection Program. So a lot of attention, a lot of focus, but obviously, you're solving the need for 5 million plus businesses, definitely worthwhile. Initially, there were forgiveness provisions, and this is the key to this program, is that these were loans, but they were essentially grants as long as businesses satisfied a couple of key measures. And those measures turn out to be fairly difficult to meet, just, complex to calculate. So, for example, initially they had to demonstrate that at least 75% of the dollars was spent on payroll. That was changed to 60% by the June 5th Paycheck Protection Program Flexibility Act. along with other things. The forgiveness provisions otherwise included having to meet, requirements to have to continue to pay wages comparable to the periods pre-COVID, and also FTE, average full-time employee counts, had to be roughly equivalent to those that were on staff prior to the COVID environment. So meeting those two measures, they came up with some fairly complicated, detailed, guidance on how to calculate that and what were the exceptions, what were the exclusions. You had to exclude wages over $100,000 per employee, things like that. Fairly difficult points to keep track of. There were also, for example, huge effort to make this easier. Easy applications, efforts to simplify, actually ended up conflicting with some of the CARES Act provisions. We'll get into the details there, but and also it says here that most banks are not processing forgiveness applications. That just changed. There was an article in the Wall Street Journal a couple weeks ago, resulting in an announcement, and I think starting October 2nd, the SBA and banks are beginning to process these forgiveness applications. I will say, though, that there's no urgency, to get your application in as soon as possible, because, the PPPFA legislation from June clarified that businesses have at least 10 months to submit a forgiveness application, so plenty of time to get that in. We do expect also further congressional activity. This remains a very hot topic in Congress. They will be looking to make forgiveness automatic below a certain threshold. They do expect a new round of PPP loans, which will be very important. Simplified measures. Also, a key point, permitting both the PPP loans and the employee retention tax credit. In fact, a couple of the bills that we have seen would expand the employee retention tax credit very significantly. Right now, it's worth $5,000 per employee. They may expand that to as much as $36,000 per employee. That was in the HEROES Act, so it may be somewhere in between those two. But expansion of the employee retention tax credit, and in particular, if you permit that in addition to PPP loans, we can expect a lot more employers to be paying attention to the ERTC going forward. I should mention there was new guidance that came out just this last Friday, so that businesses that had loans of $50,000 or less, they literally waived the FTE and wage level tests for forgiveness. So very much simplified that whole process. We're working on guidance to our clients now to kind of announce that change, but that's a very big change that just happened this last Friday. Very briefly, I wanted to mention a couple of COVID and CARES Act issues that affected the states. And again, I'll leave most of the unemployment insurance issues for Tom. Did want to mention on the example of employer payments of student loans, there's a state conformity issue, and that conformity means basically roughly half the states automatically adopt any changes to the Internal Revenue Code. So federal tax changes, states automatically adopt in some cases. And if they don't, they may either selectively adopt it or selectively reject it. So this has been no exception. The CARES Act changed the tax treatment of employer payments to student loans on behalf of their employees. But the question is now, did the states adopt that also? And again, some states automatically adopt IRC changes, some don't. Wisconsin, for example, adopted a bill on April 15 that made the same change. So employer payments towards student loans are tax-free in Wisconsin, but in contrast, in North Carolina and New York, they specifically decoupled from that provision, so they're taxable. And I mentioned that in the course of this, year-end preparation, because that means that those payments would be reportable on a Form W-2 for state purposes. So we're going to have to keep track of state by state. Is this considered taxable? Is it exempt? And if it's taxable, would it need to be in the wage line on the W-2 for state purposes and not federal? It's also likely that we'll see some late-breaking state laws changing this even after today. On the Paycheck Protection Program, same sort of thing, state conformity. What is the state tax treatment? And the question here is not really a payroll question, but really corporate income tax, which is, forgiveness of loans is typically income to the borrower. In this case, in the CARES Act provided that it's not income. But do the states agree is the question. And so, again, we have a variety of different results with states enacting legislation. Wisconsin, Iowa, Hawaii, Connecticut, for example, all adopted legislation that clarified that forgiven CARES Act PPP loans are not income to the business. But Massachusetts, New Hampshire, and many other states enacted legislation that said that those PPP loan forgiveness is indeed income to the business and has to be recorded as taxable income. So things like that will businesses will need to be aware of what the state tax treatment is of these various CARES Act provisions. Lastly, cross-border commuters and temporary presence. Again, we have Charles Collins to help us through that in a few minutes, so I won't spend any time on that, but really there's a very large issue there from the perspective of a lot of businesses, especially if they're on border towns. Many employees are commuting in from out of state, and they live in a different state where the employer doesn't have a presence, and every state that has an income tax has a threshold where someone can work in that state for a certain amount of time without the employer incurring a withholding obligation, having to withhold and report to that state. We have had a bunch of states come out with guidance on that topic, but this may result in employers literally creating new offices recognized as nexus in those new states where they have employees just working from home. Want to mention also the employee Social Security tax deferral very briefly. This was big news. The presidential memorandum, August 8th, announced that employers could defer the withholding of Social Security tax to the balance of the year after September 1. So lots of attention to that because that's a fairly major change. Basically, they clarified, though, on August 28th, which was literally one business day before it took effect on September 1, but they clarified that it boiled down to, the test was, did the worker for that pay period earn $4,000 or less? So that was helpful, but we just got that one day before it became effective. It's an employee option or employer option, I should say. The employer can choose to do it or not. They don't have to give employees a choice, but it would be difficult not to. One question that remains outstanding, as I mentioned, affecting year reporting, we don't know what to do in terms of W-2 reporting still, right? As of today's date, October 12th, we're still not sure how to handle W-2 reporting. Do you report the total amounts collected, or do you, including or excluding the deferral, or and how do you report amounts that you collect related to 2020 in 2021? Is that a W-2C? We're not really sure. Lastly, on this point, I will mention the Brady bill, which is there was corresponding legislation proposed by the Ways and Means Ranking Chair Brady that would enact a corresponding tax holiday, and that would be very, very sweeping. That would apply to all employers automatically, would require all employers to retroactively report on the W-2 what were the total wages paid September 1 through 12/31, so that all employees could get a refund. I will say that, though, that bill is highly unlikely, but we're watching it very carefully right now. And very briefly, in terms of what we're watching for, really is we're still expecting the COVID Phase 4 legislation, and at this point, what we're expecting is probably going to be after the election. So not much is expected to happen before then, but again, we do expect like a new round of PPP loans, possibly an extension of the FFCRA leave mandates and credits. Anyway, we won't get into the details here, but there are many possibilities that we're seeing in Congress. They're tinkering with what to do next in this COVID environment. And with that, let me ask Tom Crowley to help us through the unemployment insurance tax provisions. Tom?
Well, thank you, Pete. That's very informative and interesting information, and I appreciate all that you provide us. This is just my bio. Pete's already gone over that. No need to repeat that, other than knowing that I'm getting older. The first thing I wanted to try and focus on here is just to show you a copy of an article that appeared in January 2009. And at that time, I was unemployment tax chief with the Department of Labor. And things were really, really bad. We were at the height of the Great Recession, or actually moving into it, and wondering how we could best navigate these troubled waters for both employers and our claimants. Things are really, really bad. And if we fast forward to today and look at this graph that the Federal Reserve of St. Louis issued, and look at the green arrow, and that shows where we are today. And this little blip down here is where that Great Recession was. And I just want to show you how unprecedented, and that word is really overused today, how unprecedented this event, all the recession activities related to COVID are. It has never been experienced since the UI came into existence into the 1930s. I mean, never, nothing even close. This is something I copied off the U.S. Department of Labor website, and I was really trying to find out how prepared was the UI system. And if we look at the end of 2019, it shows that $75 billion, that was the collective balance for all state trust funds together. And it's just over $75 billion, which sounds like a lot of money. Now, unfortunately, the only data I have is through July of 2020. So far, we've paid out $80 billion for benefits that are chargeable and come from the trust fund, not the federal benefits we'll talk about later. Of course, that exceeded the 2019 reserves, and obviously this would lead to borrowing. This graph here shows the 21 states that have begun borrowing, and updated for today, I think it's over almost $36 billion has been borrowed from the federal government for insolvent state trust funds. And those funds will be repaid in some form or fashion. We'll go into a little bit of explanation how. I want to quickly talk about federal unemployment tax, FUTA. This slide is from a previous presentation that I did. It's funny, the last time we did this, I said the fantastic economy has erased nearly all the adverse FUTA rates. Well, that's going to change again in a couple of years. But I do want you to realize that it will be a couple of years before FUTA adverse consequences will begin. The only state, and I use that term to include the Virgin Islands, although I know they're a territory, that has higher FUTA taxes for borrowing is the Virgin Islands today. So they're projected, and it's not final until November the 10th, they're projected to have a FUTA rate for FUTA year 2020 of 3%, and that's contrasted to a 0.6% had there not been any borrowing, not any credit reductions. And just to be real quick, credit reductions, if on November the 10th you have a loan balance, a state trust fund loan balance, and you've had a loan for the previous 2 January 1sts, that means you would have a 0.3 reduction for FUTA credit, which means a 0.3 increase in your tax rate, and that increments every year that loan remains unpaid. So, okay, we're experiencing the COVID. We're experiencing significant borrowing, likely to be unprecedented borrowing, and we wonder how will this impact FUTA? The earliest that this will impact FUTA rates will be for the FUTA year 2022, and those taxes are due January 31st, 2023. And there's been a lot of discussions in Congress that it could even be further delayed if they act to delay or defer the impact. So the debt is out there today. It has to be repaid. It's interesting that some states, instead of using FUTA, they'll float their own state bonds to finance the FUTA debt. Texas has done that for many years. A lot of states took that approach last time. There's one other thing I wanted to mention is that there was substantial CARES Act funds apart from the unemployment that state had access to. And some states used those funds to put into their trust funds to avoid borrowing and to avoid increases in FUTA tax. For example, Iowa put in almost $470 million into their trust funds, and that was CARES Act money. So that's an approach that some states take, and I think 6 or 7 states have done that. Most, however, are going to be using FUTA probably to pay back those taxes. Of more immediate concern would be the state unemployment taxes. There's going to be significant increases for state UI taxes in many states, not all, in calendar year 2021. Of course, those taxes, the first quarter that those taxes will be due this first quarter, and it'll be April 30th of 2021. And if you calculate your rate for the calendar year, most states do they would measure their trust fund as of the summer or the fall of 2020, and that's when the borrowing and depletion of the trust funds occurred, and their rates would reflect that reduced amount. Some states, however, do use a fiscal year computation, and those rates will likely not increase until third quarter 2021. This is a similar timeline to what Pete had up earlier, shows the federal response. I can't go into great detail on this, but suffice it to say, when March occurred, 2020 occurred, and the economy hit the wall, there were unprecedented things that had to be done because of the very unique situation that we were encountering. It wasn't like a business was failing because of some economic activity. We were shut down. Our workers were required to stay home, and the system wasn't really set up in ways to handle that, and we had to act creatively to come up with measures and procedures to help us and help the workers and help employers get through this time. The first thing on there I just wanted to mention was the FFCRA, and that provided some $1 billion available to states to be shared proportionately to help them make the changes to their programs, because every time they put through changes, new benefit enhancements or federal programs, states have to accommodate those and change their systems to pay the benefits and also to charge those benefits appropriately back to employers when it's appropriate. The biggest takeaway from that also was the increase to unemployment insurance, access to insurance. It waived work search requirements. It waived the waiting week. Things that were considered due process and good stewardship in this crisis were waived because they wanted to get the benefits out. And it also had provisions for non-charging employers for COVID-19 related benefits. More fundamentally, there's the CARES Act that came through, and that made fundamental changes to the UI program that have never been seen before. And I cannot get into the details, but I did want to go through each of the bullets just real briefly, and the numbers in red show that, I think it's through October 3rd, the amount of benefits that have been paid out for each of those different programs. First one there is the Pandemic Unemployment Assistance, PUA. It brought into coverage for the first time ever independent contractors, gig workers, your Uber, Lyft drivers, TaskRabbit. And again, we don't have wage records for those folks. They're outside of the UI system. States had to really scramble to put in policies, procedures to accommodate this and be able to pay the benefits out. So far, they've paid out $55 billion. The second bullet is the emergency unemployment relief for governmental entities. Those typically self-insure. They reimburse for benefits paid out. They were in no way positioned to be able to handle the crush of benefits that were coming outside to their organizations, and that was $1.6 billion. The third one is the FPUC. That was the $600 a week enhancement that I think many of you may have heard. That expired at the end of July, but look at $275 billion came out for that. Again, that is expired and no longer there. Some of the other programs you can see also had significant amounts of benefits paid out. And this I just really added to the slide deck to give you something to refer back to later. I'm not going to go into in-depth description, but it is a graphic representation of the flow of benefits, who qualifies for what happens when they need to access other types of benefits when others run out. And it is a really helpful guide just to give you a picture of what we're encountering. So a few slides back, I mentioned that $600 a week and how it expired at the end of July. Well, the president authorized through executive order another part of the program that would help to provide that weekly benefit enhancement amount. So when the FPUC expired in July, they're pretty creative. They used unobligated FEMA funds so states could continue the enhancement. And that pot of funds states would apply for, but it was at a lower rate. Instead of $600 a week, it was $300 a week. And the other unfortunate part of that is that they didn't have sufficient funding to continue it. And I think most of those of the states issuing the LWA program have exhausted those funds. So once that is exhausted, and by the end of this calendar year, most of the CARES Act enhancements to the UI program will have expired. So you have to think about what is the possible future action. So Congress, again, they've been active. They're trying, the Republicans and the Democrats are trying to come up. They so far have not been able to come up with an agreement on continuing CARES Act unemployment insurance initiatives. And as I indicated, all the programs have or will expire by the end of December. In addition, there has been talk separately about delaying or deferring FUTA credit reduction impacts and interest on that states will owe on federal loans. And those loans do carry interest, and that's separate from the FUTA reduction of FUTA rates. And those are due coming up in later in 2021. So states are also busy addressing trust on solvency by enacting higher solvency taxes or special assessments to finance borrowing. And the key takeaways for employers, as you said earlier, many of the federal enhancements are not chargeable to employers, and that's so critical. And it's important that employers monitor their charge statements to make sure they're properly accounted for. You have to understand that states had to scramble to enact CARES Act provisions, and the initial emphasis is often, I've worked in the state, I can tell you, it's paying those benefits. You've got people out there, they're out of work, they need benefits, and that's where the primary focus is. And they're going to worry later about proper charging. They're going to try and do it right to begin with, but that's not the primary focus. So it's worth noting that mistakes can happen, and it is important for all employers to monitor agency information to make sure that they don't happen to you. And I've seen where states have had some significant lapses, and it really is incumbent upon you to monitor those charges. Last thing I want to talk real quickly is about, Pete spoke briefly about this, is California Assembly Bill 5. And this was the landmark legislation that California enacted to bring into unemployment coverage and other California state benefits as well, the independent contractors. And the real thrust and focus of this was to cover the gig economy workers with unemployment benefits and any of the other programs that are associated with that, workers' compensation, disability insurance, paid family and medical leave. And it's consequential for employers. It's a big responsibility, both reporting and fiscal responsibility. And then for the workers that want this, it's a big benefit for them. There were significant carve-outs where they were certain classifications of workers were exempted from it. Coordinating the different classifications for the same employee under California and federal law and coverage, it's going to be a challenge, because what you could have, in fact, is someone covered under California law receiving a W-2 for state income taxes, covered for unemployment insurance, eligible for UI. And then on the other side, on the federal side, their circumstances of employment have not changed. They're doing the exact same job they were before. And before they were considered to be an independent contractor. So it could, in theory, be where you had 1099 reporting on the Fed side, W-2 on the state side. Not aware of that happening on a broad scale before. And then further complicating this is the Proposition 22 is on the ballot in California this November. And depending on how that vote goes, it could negate the impact of AB 5. So time will tell, but there's still a lot evolving on this matter, and it is one of significant consequence. And with that, I am fortunate to turn this over to John Maya, our federal expert, who is very knowledgeable in all these matters and is really looking to inform you. John, take it away.
Thanks a lot, Tom. All right, so we're going to look at changes to year-end reporting, and I think the big thing this year is there are more changes than we normally see in several years. So it's a lot of information to cover today, and I'm going to leave a lot of it on the page as far as a resource for you, just simply because there is so much content, and we're not going to be able to go through everything in the greatest of detail in an hour session. But everything is in the slides, and of course you have access to that material. So just be aware that all that information is in the slides, and we may not cover every single thing in here. As Pete had mentioned earlier, the Emergency Family Medical Leave Expansion Act, which required the payment of emergency family medical leave. Here's some guidelines around that, only available for workers that were unable to work or telework in order to care for a child if the school or child care provider was closed to COVID-19. 10 days can be unpaid, or employees may use other paid leave. 10 weeks of paid leave, paid at 2/3 regular rate of pay, capped at $200 per day, or $10,000 for the 2020. And note just that the total leave under the FMLA, including leave for the FFCRA credit, cannot exceed 12 weeks total. Right, so it's additional leave, but it cannot exceed the total 12 weeks total of 12 weeks. Emergency paid sick leave, and again, this is part of the FFCRA. For employers that have fewer than 500 employees, and for government entities, they are required to offer this. We're required to offer this leave to their employees, regardless of how long they're employed. If they're unable to work due to the following conditions, and that's either a quarantine or advised to self-quarantine related to COVID-19, or experiencing symptoms and seeking a diagnosis. Caring for others, caring for an individual subject to quarantine, or caring for a son or daughter, as defined by the Family Medical Leave Act, and those qualifications listed here. Paid family leave and sick leave credits. Credit is equal to 100%, with some additions, of the qualified sick and family leave wages paid. Subject to those limits, the credit is also increased by any health expenses, which, in other words, the employer paid health insurance premiums attributable to those wages, plus additionally the 1.45% employer Medicare tax. And that's an important note because it is taxable for Medicare tax. They're not exempt from Medicare tax, but the employer share is subject to that additional credit, but it is not taxable for the employer's share of Social Security tax. So we'll just move through to the last slide. And I think we'll leave that at this for the family medical and emergency sick leave payments. Important thing I want to cover in some detail, a little more detail, is the reporting that Pete mentioned earlier on the Form W-2. And as Pete also illustrated, kind of late guidance coming out in July 8th, IRS issued Notice 2020-54, and it does require this reporting on the Form W-2, and it's in Box 14, or it can be in a separate statement accompanying the W-2. And again, it's intended to provide employees that may need to calculate the amount of a credit that they would be entitled to if they, in addition to wages, have some self-employment income that may have qualified for these credits. And so they need to have the wage figures from their employers. So 3 types of leave that it's required to be reported in Box 14, and those are sick leave wages that are subject to the $511 per day limit, because sick leave wages subject to the $200 per day limit because care that's being provided to other individuals, and then the emergency family leave wages up to $200 per day and $10,000 in aggregate. And just a quick note and correction here, The reference and the link provided at the bottom of this slide is referencing an incorrect document. What you're looking for is notice 2020-54. This goes to 2020-59. So to get to that link, just go to irs.gov, and in the search, just search notice 2020-54, and it'll be the first result in your search. So if you're looking to get a little more clarity around that reporting requirement on the W-2, that's where you'll find it. CARES Act had a lot of provisions, and I'm not going to spend a lot of time on each of them today. I could do entire webinars and have on some of these individual topics. The Social Security tax deferral, it is available to all employers, and employers can defer their share of Social Security taxes for the entire quarter. The deferred amounts have to be paid in two separate installments and 50%, and they're due December 31st of 2021 and December 31st of 2022. In addition, IRS, there are provisions the IRS has for an advance payment of the employer credit, and that's either the credits under the FFCRA or employee retention credit under the CARES Act, which we'll talk about in a minute. It's available for those credits in anticipation of the credits that you're going to file for at the end of the quarter. But if you need that cash more quickly, there's an option to complete Form 7200. 7200 would then provide the opportunity to receive an earlier refund, potentially from IRS. And I say potentially simply because I think given the challenging times for all employers, and IRS is no exception, it's taken longer to process those forms than their original intent. But we have seen some employers certainly benefit from that and actually getting the money before the close of the quarter. So an option if you have credits and are looking to improve immediate cash flow. The employee retention credit. This is out of the CARES Act. It's 50% credit of the first 10,000 in qualified wages for an employee. It includes the employer also includes the employer costs of maintaining health insurance, just like the FFCRA credit. Credit is applied against the employer's share of Social Security taxes, and any excess amount can be refunded, but more importantly, it can actually be used to offset other liabilities within that quarter. And it can be reduced the overall deposit and ultimately the amounts you have to pay immediately out of pocket. And credit only applies to wages paid between March 13th, 2020 and December 31st, 2020. And that, of course, subject to potential extension, as Pete mentioned earlier, depending on future legislation. But as of right now, ending on December 31st, 2020. A little bit about eligibility. I'll just let that stand. It's there as a resource for you if there are any questions about eligibility. Eligible businesses. Again, it stresses the qualifications. Important note on eligible wages. It's all wages for businesses with 100 or fewer employees. So any wages that you're paying would qualify for the potentially for the credit. For those with more than 100 employees, it is only those wages paid to employees who are not providing services, yet you're continuing to pay them. So important distinction on the employer retention credit. Claiming the credit, it's a refundable credit that's claimed each quarter until 9/41. Again, the Form 7200 available for potential advance if you have large credits and are looking to potentially improve immediate cash flow. And it can be used in combination with the employer Social Security tax deferral. So important to note. And I'm going to just talk a little bit about restrictions and dependencies of what can and cannot be used together. The emergency paid sick and family leave credits are reduced by the small business research credit or the qualified veterans credit and the regular paid family and medical leave credits. But the credit can be combined with the retention credit, with the Social Security tax deferral, and any loans under the Paycheck Protection Program. Paycheck Protection Program is, in fact, as Pete noted earlier, combinable now fully with the Social Security tax deferral, but it is not combinable with the employee retention credit. Social Security tax deferral can be used in combination with the retention credit. Loan applicants are, in fact, allowed to continue deferrals. And a note I'd like to include here is to keep in mind, if you are taking advantage of the deferral, that a deferral is not a forgiveness of that tax. It is a balance, and it will be due, even if that due date is, a year and 2 years down the road. So just something to keep in mind. And I'm going to leave this here because I want to get to some important W-2 updates. SSN Truncation. This is a new item for 2020 reporting. This is an optional. This is an option for employers to truncate, or as report as displayed with the asterisks or stars, to redact all but the last 4 digits of the employee's Social Security number on the employee copy of the W-2. So this could cause some confusion to employees if you've elected to do this. But again, it's optional, but it is obviously a security measure that IRS is making available so that we're not sending out paper forms if we're still mailing paper W-2s to employees through the mail with full Social Security numbers. So this is an option that employers will have to help provide that extra level of protection for their employees' W-2s. Federal limits for 2021 for Social Security Medicare taxes. SSA has not actually made that announcement yet this year. So all of this is kind of to be determined. We don't expect any rate changes to Social Security or Medicare rates, but we still don't have the formal announcement from SSA, and nor do we have the new wage threshold. So we will get that. There's a link at the bottom of the slide, and that link will take you to a page where that information will be available on the SSA website once that information becomes available to the public.
Okay, Charles, I'm going to pass it to you to wrap us up on state withholding.
Thanks, John. 2020 was a year of challenge for agencies, just like it was for all of you and your businesses. They had to maintain operations like you did, moving employees home to work from home, and also have an office environment to deal with the tasks that they had to have there, like opening mail. On the tax policy front, I believe the biggest issue that we're going to have lingering is how to deal with withholding for employees that are working in other states. And many states issued some guidance on that earlier in the year. I believe we had about 14 that issued something. And that's what I think you need to be looking out for in your businesses between now and the end of the year. Be sure if you have employees working in a state where you don't have a presence, determine if you need to be withholding on them and determine if you need to register. There are some legislation going through Congress that might affect it, as well as the states.
Great. Thank you so much. And we are right up against the hour, so I think we ran out of time for the last few slides, but I think we got through about 99% of the super comprehensive information that our expert presenters covered today Thank you so much for really invaluable information on year-end reporting strategies. Just a quick note, this content and webinar was pre-recorded, and then just last week, a few updates to PPP loan forgiveness was released. Our presenter referenced details on this legislation, mentioning that we were still waiting for guidance at the time. But of course, in the times we live in now, things are changing so fast, and new guidance was released. So we invite you to download the ADP Eye on Washington resource to get the latest information on the new exemption from forgiveness reductions for PPP loans under $50,000. And we also encourage you to subscribe to the ADP Spark blog so you can continue to get the latest from our Eye on Washington team with breaking news and updates. And then finally, just want to say that we are so proud to be a preferred partner of the MACPA. We love working with their team and with Tom Hood and getting to know all of the members, over the years that we have been a part of the association. So we're really proud to be here. With our unmatched expertise, insights, and solutions, we want to help you guys build powerful firms and be a more strategic advisor to your clients. So don't forget to sign up for Accountant Connect if you're not already on it today. It's a complimentary tool for you to get tons of practice management tools and resources, as well as access to your authorized ADP clients' payroll data. Finally, Deb Kraut is your go-to for the MACPA. So if you have any questions or comments or want to know who your contact is at ADP, Deb is your person. She's had over 30 years at ADP working specifically with the accounting profession in Maryland. And again, I'm Laura. I am an extension of Deb and happy to be of assistance at any time as well. And we'll likely continue to get to know all of you. So thank you so much for tuning in today. We enjoyed having you, and we are excited to continue chatting in December at the Innovation Summit. So thanks so much.